how to build a multi-million dollar portfolio. Surprisingly, only about 8% of people really own an investment property. That's a very small ratio. The uncertainty is what really bugs you down. It really puts you into pressure about what do you want to do, whether it's a good time, it's not a good time. If you just look at, say, maybe about $200,000, $300,000, which you invested in 10 years, it has become 4 times. That's how you've leveraged out the equity. And leverage is what really helps you get into a larger portfolio, get into buying more and more from the same deposit which you have contributed at some point of time. So guys, welcome. We have so many of us already who have joined in. I know there are more people who are trying to come into the system, and they're being invited into through the waiting rooms. But yeah, we are already at 7:01. I don't want to delay it for too long, and want to start off immediately with our agenda. We've got a lot to cover. It's a very popular topic. It's a very popular bit which people want to understand and want to see how it's going. But again, it is vast. I would just put a small disclaimer, which is there on your screen, that we're talking in general in nature. It's very just to give you information. We can go as deep as you want, but then it can go on for 3 hours, 4 hours, and we don't want to do that. We want to give you the summarized objectives of our topic today. And then if you are happy, if you like it, and if you want to know more, we'll come back at the end with our details, and you can get in touch to get more about how it's going. But without waiting anymore, we start off with what we want to learn today, what we want to know about today. That's basically how to build a multi-million dollar portfolio. Everybody's thoughts always come to that. How do I do that? Everybody wants to do that. We all want to do that. It's very surprising, though. I'll show you some data which does not point to that, but I'm telling you on the level, when I talk to everyone, everybody wants to have a portfolio. Everybody wants to have at least a couple of 2, 3, 4 investment properties with them, have a small portfolio, large portfolio, whatever suits them, and then go on with it, and then try and build a bit of a momentum, try and build a bit of a wealth around it, try and plan out for their future. Some people, they want to travel the world. They want to travel at a lot of places. There are people who would want to leave a legacy behind. There were people who want to fulfill their ambitions. I know people who are trying to learn music at a very advanced, and there are shares about 12% of people, and surprisingly, only about 8% of people really own an investment property. That's a very small ratio. Very, very small ratio for a country which really loves real estate, which really loves to talk about real estate. And the most important one for us to understand why we need to build a portfolio, why we need to think about building a portfolio, why we need to think why we should really put our minds on that, which is just a property market. Not everybody may decide to go into that, but that's an opportunity. That's a demand boom which is waiting on the horizon. And we've all seen in the past that whenever these kind of booms come, they just suddenly go through the roof, and suddenly become too wide, and suddenly become too quick enough for people to be able to manage, and to people to be able to understand why it's happening. Whereas people who are planning, which we saw on the first graph, people who have at least 1 or 2 or 3 interests, 3 properties or something, they are loan structuring is very important. How do you ensure that your cash flows are met? How do you ensure that you're able to really sustain the portfolio? That's where the wealth is accumulated. That's where the wealth is generated. That's where we finally reach to a place where we can say, okay, we are doing good. And properties and selection of growth in mind, but that's not the bit. There is also tax advantages or disadvantages. There's also risks which come with the property. There's also leverage which you have to see, whether you're able to really leverage it out, whether you're able to take a benefit there. The rate of interest, the gearings are important. Most important bit, if you will see at the down there bottom in the middle, is your exit strategy. When do you really go out? Okay, you bought a good property 3 years ago. You were in Perth and you got a good property for $400,000. It's worth $750,000. Do you go out now? Or do you think it still has a lot of steam into it and it can reach $1 million? Do you exit now? or you exit too late? Or do you think that I will exit later, and then you find your circumstances have changed and you have to exit at a point of time where you can't really exit, and it's not a great time to do that, you're not making enough money. But what's your exit strategy? Very critical to know. What are your risks of carrying on with an investment? Very important to know. Especially when people are looking into commercial properties, risks become even more. When you're looking into properties which are in a suburb which is going to grow, future growth, future related areas where infrastructure growth is going to come in, risk is pretty important. So all these strategies, you need to sit with your mortgage broker, you need to sit with your financial planner, you need to sit with someone and understand how your strategy is going to be. Otherwise, you'll just be a property accumulator going towards getting properties which may or may not align with your future. And in a couple of years, you realize, oh, I've made a mistake. Oh, I've done this. But properties are not like fast food. You don't really have a bite of it. And if you don't like it, you can discard it. Properties are there for life. An average person, we saw in the earlier sheets, will have 1 or 2 properties in their year. It's not so easy to churn it around. Then comes capital gains tax, then comes all your income tax, then comes a lot of things. And more importantly, comes the disappointment of having missed out, having not being there, not having done that. And that's something which we really want to avoid. So investment strategy, most critical. That's the important thing which you need to do, and you need to sit on it. Whoever is your planner, whoever you really sit with, whoever you want to take an advice from, that's the bit which you need to really be focused upon. Once you get your investment strategy in place, then comes the power of leverage into play. I'll take you through a couple of examples about power of leverage, but just to leave this thought behind you. Power of leverage comes with about 3 or 4 options. You can leverage your financials, you can leverage your operations, time, and yourself, which is the most important one again. But the impact of all these 4 are different. If you're leveraging your financials, which means you're taking money out of a bank, you're taking money from the financial institutions, and you're able to multiply that, that's really where the wealth building comes in. That financial leverage gives you the strength to be able to go somewhere and strength to be able to drive yourself. The impact of an operational leverage is growth, which sometimes is business growth or about your growth or about how you work, but it's about how you can lower your expenses and still generate more profits out of it. Time is another critical one for us when we are building an investment portfolio. These 2 ones, the financial and the time, are the most important one. Time is where you really take advantage of an expert and their expertise and their knowledge to be able to save yourself the bit of doing it on your own. How an expert comes into play is very simple. We all would want to know how the market is going. We all would want to know how it is going. But we may find that, okay, I can research through Google, I can research through Newslines, I can research through a lot of stuff. But then I have to read through and understand. We spend 6 months or 3 months or 4 months in trying to understand, but the market has moved up 10%. That lost opportunity, that opportunity cost is big. And an expert can come in and solve it for you yourself. I've done a bit of things in my house. Everyone's done that. I've done a bit of a work. Okay, I like to go to Bunnings, get some stuff, get your plane done, make a small thing in your backyard. Then you realize, oh, my quality was not great. Or I messed it up somewhere. Then you have to call a handyman, you have to call a plumber or electrician or whoever, and then you get them done from an expert to get it right. But eventually, and then once the expert comes in, it looks beautiful. When you've done it, you like it. Obviously, you've given birth to it, but you kind of have missed out on something which was really nice. The euphoria goes away very soon. That's where the expertise comes in. That's where the leverage time comes in, and that's what really helps you scale very quickly. And we've had so many times. Being a mortgage broker, I've seen people come back to me and say, Parag, if I would have known this, I would have done that differently. And that's where an expert advice comes in. But very quickly, I'll touch upon 2 slides and I'll move on very fast. This is about a client who's, just to give you an example of how leverage works, who about in 2015, obviously in good times as well, bought about a 1.1 million property, just took a 950 loan, about 200K from their pocket. And in 2019, they accumulated something. 2021, they accumulated something. 22, they accumulated something. Today, just at the exit of last financial year, they're sitting at more than 6.7 million of total asset base of the properties which they have purchased, which is all multiplied from the equity which they've used, the initial $200,000 which they had put in, and about a little bit more which they had put in between. they now are sitting on a free equity of 1.4 million. If you just look at, say, maybe about $200,000, $300,000, which you've invested in 10 years, it has become 4 times. That's how you've leveraged out the equity. And and they're still having these properties. They're still leveraging it. They're still going forward. They'll still be able to buy much more. With an equity sitting off about 1.4 million, you can really buy another 3 or 4 properties, 5 properties now with your borrowing capacity, which they have. And definitely in another 10 years, if we'll be talking about them, we'll talk about a very different scenario. Very quickly, again, another one in which these guys, they started smaller, had more medium level of income, lesser than the previous example. 2017 started very small, about $150,000 property, exited out of properties as well over the last few years, got about 5 property portfolio, have now bought something which they dreamt of from their equity, which they wanted. They have now about 600,000 odd of equity, which they've already generated, and are looking at going through their dreams, having their acreages, having their loans in control, having the equity built in, and they can exit out of it. Just sell a couple of investment properties and that's it. You're sitting with a couple of properties with yourself, which have no loan on it, and you're notionally debt free today. Anyways, I'll move forward. I can talk at length about the power of leverage and talk at length about how you can use your equity, but we're limited time today. Ownership structures, again, very important. Whether you should buy an investment, whether you should buy as a trust, whether you should buy in an SMSF, we get these questions all the time, and that's what is going to really help you build a larger portfolio. We have people who will start off with an investment, buy a couple of them under a trust, which are positively geared, buy a couple of more under a different trust, which are positively geared. They are able to accumulate more. They are able to save on tax benefit. They're able to save on land tax. They are able to save on these bits, which really gives you the option to go faster. SMSF, leverage your super, get a better rate, get more control. That's what people aim for. That's what they want to do when they want to set up an SMSF. Take an advantage of tax benefits, which comes to you with various states about where you're going, and they are able to accumulate something which can be a high capital growth property at your time of retirement. If you even exit out of that property, it gives you tax benefit at that point of time, a large tax benefit at that point of time, which nobody really sees, which you normally don't see in an investment property. But there are rules and laws around it, which an accountant can always guide you around that. Loan structures are very important. Interest only helps you have cash flows. It allows you to accumulate more, to be able to buy more properties with the same thing. Very type of loans, variables and fixed and hybrid loans, keeping splits. Obviously, equity, which I'm again touching upon, that's the power of leverage, which we spoke about earlier. That really helps you turn on into investments. Having said that done, now comes the most important part. When you are building a portfolio, when you are wanting to go ahead, when you are wanting to talk about how I accumulate the wealth, you will now get into the stage where you would want to get properties. And that's where it's important and critical to know how do we accumulate a great property. And I'll hand over this to you, Julius, right now to take us forward with that.
Thank you, Parag, for the insightful session. So, hi all, let's discuss about how we can identify a next great property. So basically, when we look for the property, right, we all are buying the property to gain good equity on it. That means when I'm buying a property of $400,000, I want my property to become around $600,000 in next 2 to 3 years, which is called the short-term gain. And over the period, historically, what we have seen is in Australia, in every 10 years, the property price has gone double. That means annual growth, including compounding, which is around 7%. So to achieve that, what are the steps to be taken and how do we do that? So basically, there is lots and lots of data available in the market. It's very complex structure. So when we look for the data, right, it's a double-edged sword where when we look, so when we wanted to get into the market, when you are in the bottom of the market, yes, it's easy. You get into the market, you go to the any cheaper suburb where demand and supply has a lot of gap. Wherever the demand is higher and then supply is lower, yes, you'll have a nosedive effect, and then property prices tend to go up. But why that property prices will go up in long-term basis? What are the actual fundamentals? Or sometimes you'll get into the suburbs where, because of the demand and supply gap and a lot of media hype or a lot of investors hype, into the suburbs where, okay, temporarily you'll get a good benefits on your investment, and then later the prices will get corrected. Similar what is happening into the Ballarat now. The prices have moved to the 2019's prices. So how we can achieve the short-term and long-term growth is where we have to align the different fundamentals. So for an example, demand and supply is one of the indicator, but how are the future supply look like? How to predict the future inventory? What kind of population growth will be happening there? What are the projected population growth? What are the incomes in the local population? What is the projected income? And what is the historical trend of that entire area? How many years people hold the properties? So there are so many factors which we have to align, and then we have to marry that data and we have to come to the conclusion. So to solve that big puzzle, we have created a software called Propel Next. So Propel Next, because as I've said before, there are like more than 15,000 suburbs in entire Australia. So how do we find or drill down to the suburbs where you have to invest? So for an example, out of that $15,000 suburbs and more than hundreds of data points, what are the data points which you have to consider, which will impact on a short-term and the long-term growth? So when we say a definition of the growth, what kind of growth are we expecting? Are we just expecting a short-term growth where you just get into that suburb, gain what you have, and then flip the property and come out of that market? Or you wanted to hold the property for the longer time? Whether my suburb will become a next $1 million suburb. So that's a big puzzle, right? And to solve that, we have collated all the data. We are getting all the data from the Munchup APIs. We put into our system, we applied our algorithm, and we have come up with the system which will give us a score, which defines, well, in score of 1 to 5, where the 5 is the worst and the 1 is the best. And we can categorically define and filter the suburb which will become a next hotspot. So in this system, what we have analyzed is basically how is the current demand and supply is looking like, whether current demand and supply is in the cold spot, warm spot, or hot spot. What are the predictive analysis according to the future trends? How the supply will impact, whether there will be any excessive supply coming up in future. Then we are looking for a C5 index, what kind of population is living there, whether the entire area is gentrifying, because gentrification is important. We can't just go and buy a property where there's a reverse gentrification happening and then lot of commission homes coming into the entire council. So we collate all this data, we marry that data, and the system gives us a score which will define which would be the next $1 million suburb. So in Propel Next, what kind of metrics we analyze? We analyze the demand and supply related metrics. So demand and supply means basically what is stock and market, what is the current stock of market, and then how the stock and market impact the future. So currently, yesterday I was analyzing the Ballarat markets where the affordability, which is a fundamental market, is okay because market is so affordable. But when we look at the other parameters, which is like stock on market will be high, inventory is too high, the future inventory is too high, future days on market will be too high. That means the affordability matrix is matching. But when we look for the demand and supply matrix, which is shaky, that means yes, in long-term basis, probably you will have a little growth, but in short-term basis, which is required for every investor. So for an example, if I'm an investor and I have an aspiration to have a bigger portfolio, then I need to have that short-term growth, right? Because when I have that short-term growth, I'll withdraw that equity in a short-term basis, like in 1 to 2 years, I'll use it as a deposit and I'll buy another property. So for an example, if you take an example of the Ballarat market, I couldn't see that. So when we look for any investment suburb, the short-term growth and long-term growth, both are important. So demand and supply indicators are very important because yes, that's the indicator which will give you short-term basis growth. But if you have to identify that suburb which will grow on a long-term basis, Then there are another fundamentals like demographic changes, like population. Whether if the population is moving faster, if there is a good projection of the population, then what's the age group of that population? Whether the young families are moving into that particular suburb, what are their incomes? And then we look at the affordability, because there are a lot of suburbs where, yes, demand and supply gap is extremely high, but the localites income is not so high that probably you can't extend the prices of the house above the certain median prices. So it's the cap to the properties prices. Also, we look for basically future building approvals. Probably, yes, you will have a very limited supply now, and yes, incomes are pretty high, but there will be an immense amount of land which could be developable, and then we have to look for the future building approvals with prescient planning, because prescient planning is something which has been planned for around 10 to 15 years. And then if prescient planning has been developed around 15 years ago, like there's a lot of prescient planning happened across the Western Melbourne. That's why what we can see is now there is immense amount of developable land which is coming into the market, which is actually excessive oversupply and not letting the property prices to go up. So we have to look for those type of indicators. Then we have to look for the socioeconomic indicators, where whether the gentrification is happening into the positive manner. Yes, the commission homes are there, but on the entire street, we could see around 2-3 years ago, probably there will be 10 commission homes. So now that entire cluster has been moved to another suburb. So when we see the gentrification happening, that means the good income earners are moving into that location where the supply is lower, demand is higher, affordability is increasing, and then that's how the property prices tend to go up. So when we marry all this data, then yes, this is a good conclusion where we have to buy the properties. So in Propel Next, we collect this data. Okay, so this is when you look at the this is something which we have built in our system. So this is actually a backend where we in ABS term, the entire Australia is divided into 4 category. It's a statistical area 4. That means it's a combination of the multiple councils. Statistical area 3, that means the entire council. Statistical area 2, which is the suburb within the council, and then statistical area 1 means it's a subset of the suburb. So when we look for the when we are doing a research on the entire area, we start with the statistical area 3 and statistical area 4. Statistical area 3 has a good amount of data, which is more cleaner because of the bigger boundary, and then only suburb can't grow by itself if the council is not doing good. So when we look at the council, we marry around different type of indicators. So like we look for the historical trends. So when you look for the historical trend, for example, if it is a 10 years price change, what does that mean is, one means it's a good indicator. That means historically those councils are growing good, and there'll be at least 6 to 7% growth from last 10 years, which is very strong data point. Then we look for recent sales history. So for an example, if I wanted to get into the cold bucket, yes, I would have to wait for the growth to come from in next 2 to 3 years. But when I'm entering into the warm spot, then yes, the growth will come in next 6 to 1 month. That's a good starting point, because you can hit the bottom of the market during that time. The property prices are not too high, vendor discountings are pretty high, so basically you can negotiate good on the property, and when the markets will turn from warm to hot, you'll have additional benefits. So we look for those type of trends. Then we look for basically vacancy rates, we look for rental yields, we look for basically buying affordability. Buying affordability is very important metric, because wherever the affordability is very high across Australia, and then your demand and supply indicators are matching. So similarly, like Ballarat, the demand and supply is in the cold bucket, but affordability is high. So growth will be in the long-term basis. So in short-term basis, you will not achieve any growth. But wherever we see the affordability is high, but demand and supply indicators are matching, these are the locations where we have to look for, because yes, there is enough affordability. So if population growth is happening more, people's income are pretty high, and then demand and supply has a lot of gap, that means yes, that area will be poised to the growth. So we look for the buying affordability and the renting affordability. If rental rises are happening and the buying affordability is pretty high, and demand and supply has a lot of gap, then yes, prices tend to go up. So we put all this system data into the system, we build that algorithm, and according to that we put the index, which is our score, and then we come up to the conclusion with the suburbs. So these are the list of the suburbs which we have added. Yeah. Then what we look for is basically population growth and the C5 index. So when we look for the population growth, right? So we marry the population growth with all the Sensex, and then we see, okay, how the population growth trends look like. So population growth trends means basically whether your population is happening above state average for that particular council, or it is going below state average into the particular council. It also tells us basically what kind of age group is moving into that particular location, whether the retirees are moving, or the basically adults are moving, or young families are moving. Whenever we see the trends of young families are moving with the high income earning, that time there are good amenities or infrastructure which has been created by the council, and these are the area where we have to focus. So that's why population growth, healthy population growth, and population age is very important. So we have included in our system. Then next indicator is basically it's a C5 index. C5 index means affluency indicator. 1 is the very low socioeconomic area versus 10 is the high socioeconomic area. Whenever we look for the demography, right, when you go with the high socioeconomic area, is already expensive and affluent, where yes, the property prices are good, they'll tend to grow, but affordability is the biggest crisis because rentals are less and the properties are expensive, so there will be a lot of out-of-pocket expense. So to avoid that, we try to get into the location where they're gentrifying. The socioeconomic index is changing from mid to high socioeconomic area versus all other data factors like demand and supply, incomes and affordability are matching. We try to get into those locations. So this is very, very important factor. So we could go into the low socioeconomic area, which is gentrifying, where demand and supply has a lot of gap, wherever the affordability is increasing, and then we can go up, so property prices will go up. Then the job diversification is very important. So what we look for is we have categorized the entire Australian job market into the multiple major and minor job categories. Wherever the major job category is more than 20% is a high concentration risk of the single industry as per our system. So that means if the major job categorization risk is more than 20%, that means dependent industries total employment indicator is around, dependency is around 60 to 70%. It's like a bigger mining town like Mackay, where the dependent mining dependency is around 50 to 60%, which is not healthy. So that is very important matrix. We have included that in our system also. So we marry all the data and we come to the conclusion. When we have finished the research, we get the councils. According to the budget, we get it to the suburb. Then we go into the street level, we do the due diligence, and then we started buying the property. So what we found in Propel Next. So basically, when we have released the Propel Next to our internal systems for the research, as per our predictive analysis, we found that regional NSW was stacking up good around 7 months ago. We started buying the properties where the properties are around 6 to 7% positive into the vendor discounting, where a lot of people were investing into the regional Queensland. We have noticed that valuations were not stacking up. We have done the gap analysis where the property prices have overcooked. A lot of people were behind the very tight market in the WA, where the regional NSW's market was very quiet, and then it was turning into the warm to hot. We have identified that location. We went to that locations around 7 months ago. We bought few properties around with the discount of 7 to 8%. The current vendor discounting is less than 1%. We bought the properties are in between 350 to 450,000. Current valuations are stacking around 100,000 more. So that's the leverage of the data and the Propel Next, which we have designed. So now these are the few locations which we have identified with the Propel Next, which could be a potential next hotspot. So we go with the state and the council. So let's talk about the South Australia. South Australia is the state where supply is all the time very low. demand is higher. The state is growing towards the northern side because southern is very expensive on the blue chip. On the other side, you have the hills, and one side you have the ocean. Northern side of the South Australia, where there are few councils, Salisbury, Treaty then you have the Playford, where the land is getting very expensive now because there is not more land available. So what we have seen in the Treaty is infrastructure development is very high. Demand and supply indicator has a lot of gap. The government has big, massive infrastructure projects happening. Population growth is very strong, and then current average annual income are pretty high. What we can see is the weekly incomes are falling in between $1,700 to $1,900 a week. So according to the Propel Next algorithm, that's the best council to go for. The next is the Western Australia. You all know that it's booming. It has multiple councils. So when we look at the council, there is a metro city, and then every metro city has a significant urban area as per the ABS. So Bunbury is another significant urban area in the Perth, which is around 100 kilometers south of the Perth, has good connectivity to the water. They are spending around $1.2 billion in Outer Ring Road, around $1.4 billion in lithium factories. Major infrastructure projects are coming up, good population growth. In Queensland, we are focusing more towards the Brisbane and as well as the Tweedshire Council because of the massive infrastructure upgrade into the council. In NSW, in Shoalhaven, has the biggest Shoalhaven, Lytton and Wollongong. According to the Propel Next indicators, our score is around 4 out of 5. That means they are turning from warm to high. And then the best thing about is in NSW and Victoria region is Albury and Wodonga. Albury and Wodonga are always historically a very tight supply pocket where the massive rail infrastructure projects are coming up. Historically, Albury and Wodonga are always growing at around 6 to 7% price guides. So historical growth is very strong. Currently, the demand to supply ratio has already changed, and the market is turning from warm to hot. I'll hand over this from the Parag.
All right. Okay. Thank you so much, Julius. That's so insightful, and that's so much which is coming from you. It's amazing to see your understanding about the property market, and that's where a portfolio comes back to. We can make strategies, we can make our plans, we can decide our ownership structures, but if you don't have the right property in the right location at the right time and capitalize on the opportunities which are coming across, which are presenting it to yourself, it's a lost cause. So the combination of a strategy of ownership structures of properties, strategy and property, two together are going to be a big winning combination. And 2025 looks very promising to all of us. It's very likely that we are going to see a property price rise. Here we know interest rates are going down. We know there is a demand and supply gap coming in so many locations. What Julius was showing was a sheet with all those reds, 1s and 5s, and you could see that there are so many of those locations where we can see that the demand and demand supply gap is widening, and there is a much higher demand coming up, which points to what the interest is going to be in those locations. Construction pipeline is weak, not a secret to everyone, and everyone knows it, how it's going. Interest rates going down, a lot of these things are moving in, infrastructures coming in, government incentives are coming in, which is what is driving the whole thing across in 25. How long will it take us? How further will it take us? How strong will it make the market? How it takes a turn in this year? It's an anybody's guess game, but we, at least at this stage, we can say there is an interest which is building in. There is a query which is coming in. And as a mortgage broker, I can tell you that my phones are ringing very quickly now. I've got people who've come back to me after 1 year and said, okay, Parag, we were looking to buy something last year, but now I think the time has come, and I think I want to take a plunge, and I don't want to miss out on this time. I missed out last time, I missed out some other time, whatever, but I don't want to miss out on this time. I don't know how much it goes on, but that's where at least early indicators are. And I hope you all capitalize on these earlier indicators and get into something which you really want to get into. What about us? Why working with Nfinity and why working with PropWealth works for you? Very simple. We understand your goals, and that's where we start from. We don't start from anything else. We start from your goals, your objectives. We sit with you. We want to understand you. We want to understand what you want to do, what you want to achieve. We want to understand where you want to go. We want to understand what suits you, what fits you. And from there, we want to move ahead. We want to present to you the best options with the best due diligence which we can. We always are committed towards ongoing support. We are committed towards being with you, holding your hand and taking you through how it's going to work, taking you through how you will be able to succeed, and making a strategy for you. And that's where we are. Sit with them to understand and make reviews and take you forward with your goals and take you forward with what achievement for us. Very simply on the screen, you can see we've got some great feedback. We've got some lovely feedback. We are very, very, very honored and very, very lucky that we get fantastic feedback from clients who talk about us, who talk about our trustworthiness and our reliability, and who really think that we are committed to the cause. And that's what we are here for. We just want to spend time with you, and it's given us results in the last 12 months. We've got besides people who have been advising, and there are some great people who've been advising, but we've been able to show much better results over the other competitors, over people who have done it themselves. We've been able to show more, and this is predominantly being created by touching upon same property price which was purchased by external to us, and property purchase which were done by us, and what's the result which has come through. That's how these parameters are built in, which really helps you go through there. But anyways, I don't want to take too much of your time. We are at 7:50, and I want to keep a lot of time for questions. I know there have been quite a few which have come in. A lot of those which have come in, and we'll try and answer. I really am committed to not shooting our time of finish, which is 8 o'clock. We've got 10 minutes more, but just in case, if you want to know more, I know we would have not covered as much as you wish, but we've got an hour and we need to wrap up quickly. We would love to share our knowledge. We would love to talk to you. We would love to speak to you and explain to you whatever we have in our mind. Shoot us as many questions, book an appointment with us, call us up, email us, find us on social media. We're there on LinkedIn, we're there on Facebook, we're there on Insta, we're there on all the social platforms. You can connect one-to-one, you can connect through our page, through our this thing, but don't keep it in your heart. Just shoot out any questions. No obligation, nothing which you really need to really commit to us. We'll be happy to give you our bit. But yeah, I would love to take the questions which we can now. We would love to talk to you and give back to you what you've been asking. But before I give those question answers, start with those answers, I know I have those questions popping up, but just to tell you, we have more than what I expected. I'm sorry, I don't want to break my word, but if there are people who really feel that they are pressed of time, I apologize that I can't. If I don't finish it, you may move forward, but we would love to answer as many relevant questions as we can at our bit now. All right. The first question, which I would take it, I'll have request Julius to do it. As BA buyer agent, do you ensure all council approvals are in place? And second, is Melbourne still hot? All right, Julius.
Yeah, so when we have a thorough due diligence system, so what we do is basically, it depends on the asset. So whenever we are buying an asset, if it's a standard 4-bedroom, 2-bathroom, double garage asset, which is a recently built property, then yes, it's already council approved. We have a system to see, we check all those aspects, and then our property manager select the property, they go and do the inspection, and then we go for that. There are a lot of times when we see they are the granny flats, or sometimes now there is a concept of the container homes which is already been put on at the back, or sometimes they create a sunroom. So these are all the patios. These are all the properties where we have to check a thorough approvals, because there will be chances that the granny which has been at the back at the property would be just built as it is without any council's approvals, and then later council will knock it down. A lot of time people build the patio without council approvals. Container homes specifically because they are not compliant as per the Australian laws because of the height restriction as well as insulation. So yes, we do check all those things before we select the property. And the second question is Melbourne still hot? So Melbourne is a very wide territory. So it growing exponentially across all the directions because it's omnidirectional. Because of the excessive land supply, Melbourne has a lot of varieties to offer. So basically, yes, we are still investing into the Melbourne in certain areas where demand and supply has a lot of gap, but we can't expect Melbourne to be a rise overnight. There are few locations in Melbourne. There's council like a Casey Council or very close to the Deer Park or close to the CBD where the demand and supply ratio is a little lower or vacancies are a little lower. And when you look for the basically rental yields are slightly better. So there are few locations where we can invest now and look for the prices to be raised. But similarly, more expensive properties in the Melbourne are really an undervalued asset. There are a lot of pockets within the Melbourne where they are falling in between 600 and 700,000 ranges. Whenever, because of the affordability that people try to move it from 600 to 700, there is another pocket will offer you great feasibility in the Melbourne. So Melbourne, it's always a very tricky market. You have to select your council properly and then look for the asset. So few pockets of the Melbournes are getting hotter, but not the entire Melbourne.
I believe Victoria and
Yes.
Victoria has always been very nice, but for the last couple of years because of external factors, land tax and investors getting lower rentals, and there were been clamped down by the government regulations, which may or may not have been right. Not that different discussion, but all this have been a factor which came into Victoria as a market. In this year, we are all hoping that these will start changing. High interest rates have really hit Melbourne hard, or Victoria hard, really hit them hard because the combination of lower rentals plus the taxes plus high interest rates have made it not very interesting for investors. And that's where you found that investors are pulling out. The ones which are stronger, the ones which are more astute, the ones which have a longer term horizon are looking to come back into Victoria. The reason is that they all believe that Melbourne, Victoria has really corrected to a large extent. And like Julius said, pockets of Victoria will start improving, other pockets will follow, but there will be some which will really take a leap.
Yeah.
And having said that, I'm going to the next question. What are the hotspots in Perth and Adelaide? Again, I assume WA and South Australia, but yeah, easy to say Perth and Adelaide.
Yeah, in Perth, there are few hotspots. See, Perth had grown immensely. So when you go towards the southern section of the Perth, especially Rockingham Council, where the employment is little higher, or affordability is not that great, even the demand and supply has a lot of gap, the property prices will not move further. It will be eventually a little bit because after the interest rate cuts, but the areas to invest were in towards the southeast, as well as if you go towards the Swan Council, if you towards the Gosnells, Thornley, which are the inner CBD suburbs, they are the actual places where we want to invest now in the Perth. In Adelaide, prices have moved a lot. So previously the Playford Council was affordable, which was around 300 to 350. Now it is moved up to 600. Wherever in the north, if you'll see a deal which will be below 600, in Playford in between 500 to 550, and towards the Salisbury in between 550 and 600 are the good pockets to buy, provided the property selection is better and thoroughly due diligent. That's it.
All right. Yeah, no, that's right. So there's still a lot of hotspots which are looking up in both of these states. And again, it's the important thing is not to look at the whole state, look at the whole big city. Just look at in the pockets where there are opportunities available, and then invest there and take a benefit in the longer and the shorter term both as well. Another one, and like this question, Somebody's asked us that I'm in the mid 50s and I'm a first home buyer, and what should I go for? Principal place of resident, or I should go for an investment property? I'll take that. I'll to with all respect, see, it's it's nothing to do with the age. It's more to do with what you want to do. There are times where families have come back to us and have said that uh, investment really makes sense for us, but emotionally, I need a place to live in. I'll feel settled if I have a house and I can walk into the door. I open the door in the evening from my work after I'm tired, and I feel welcome and I just feel relaxed. I want to have that feeling. Investment can be on the side. Totally respect that. That's the way we all have thought and we think at a lot of times. And that's when you should go for a PPR. But if you say, I don't really mind, I want to stay in the best suburb, which I may not be able to buy in, I'm happy to pay the rent there, and I want to still ride the wave of investments and still ride the wave of property cycles moving up, investment is for you. It's individual. It's goals which you really want to achieve and goals which you want to go for, which drives your decision about whether you should go for an owner occupied or investment. You're not too late for anything. Age is not an issue in this. It's more of your objectives. All right. I'm sorry. We are at 7:59. We have a couple of more questions. I'll just go for that. And this is more for Julius. As a buyer agent, what is your fees?
Yeah, so we charge very nominal. It's $12,000 plus GST. Out of that, we take 20% upfront, and then rest of the amount will be payable when the property contract will be unconditional. The services includes all property selection, getting a property at the right price, negotiation, due diligence, and end-to-end transaction till the property management.
All right, thank you.
Yeah.
What happens when you have equity but have exhausted your borrowing power? All right. Extremely common scenario today because of these high rate of interest. You have so many people who will come and say, my house is worth $2 million, $1 million. My loan is only $500,000. I have equity. Can I buy another investment property? Unfortunately, that's not how borrowing capacities work. It's as simple as that. Without to tell you, if you have no income but you have no loan on your house, will anybody give you any money? You most likely no, because you won't be able to repay. And that's where borrowing capacities come in. Unfortunately, if you don't have the income, if you don't have the borrowing power, there's not much you can do. But what you can do in these scenarios is you have to really evaluate how far and what options have you chosen to get your borrowing power in place. Have you looked at all the options? Which means sometimes people will stop at the top 4 banks to see whether I have borrowing capacity or not. We can look at much more options. Many other lenders which are there, smaller banks are there, non-banks, some really phenomenally great non-banks which offer great value are there, not too expensive are there. Then there are the second tier non-banks which are there, which can help you borrow if you're really looking to borrow. Then there are options like borrowing under an SMSF. There are options which people follow for SMSF. The option people follow under trust. There's a lot of things available. If you've exhausted all of them, then obviously you'll have to wait for interest to come down. But if you've not exhausted, then you can just reach out and we can help you understand how much your borrowing capacity can be. Sorry, I'm just trying to run fast. We're just 1 minute above 8. And if you really are wanting to move on, there are a couple of more questions which I'll take, and I'll not take too much long. And then other questions, maybe we'll write back to you, and then you can, or you can reach out to us directly. Very quickly. Again, Victoria. Victoria looks very popular, I think, Shepperton. What about Shepperton? Julius?
Yeah, so Shepperton is a good area to invest because it's affordable, the yields are better, but there are not a lot of pockets in Shepperton which are not flooded. So look for flood zones. Look for good pockets because there are a lot of rough pockets and industrial pockets within the Shepperton. Avoid the rough pocket with the low socioeconomic area, and then it should be fine. So it's a good place to invest at this stage.
All right, I like to take this question, the next one, which is the last, which I think we'll take because we don't want to be too late. I don't want to keep you away from your dinner if you've not had one. This is a very interesting question. Are your algorithms based on PK. I'm assuming this is referring to PK, who's the investment guru, and he talks a lot about how you can do it yourself and how you can really search for properties about yourself. He's a pretty learned man, and he has got a great fan following. But no, we don't have our algorithms which are based on him. Definitely, there are data researches which he would do, and there are so many other people also there out in the market who are great, who are lovely, who have brilliant advice to give, who can talk at length about where you should go for. But everyone has their own niche. We have our own one. We have our own system. We have our own analysis. We have huge number of data points which we look at, which may or may not be similar to what PK looks at. But definitely, we have our own advice which follows through. And we really stick by our advice. We really stick by how these can work. We have parameters which Julius has spoken about in this presentation, which we really focus upon. We really deep dive into it, and I'm pretty sure if you would want to have a chat, we can have a what do you call, a Zoom session or a Team session or a Google Meet session, and we can show you what data analysis we do and how we do that, and why we are able to be confident about locations which we are talking, which can do well. And that's where the strength of analysis is all about. That's where people who have been into data can bring value to you, which includes everyone, so many other people in the market. And we are very sure that our analysis is pretty unique and pretty different, and very, very useful for a lot of people. But having said that, it's 8:05 and I'm keeping time like crazy. So I don't really want to go forward. I have about 7-8 more questions, but then it will take us to much further than what we want, and we don't want to do that. I'm thankful for all of you to have joined us. Thankful for you to would have come and patiently listening to us for all this time. I've seen that most of the people are still there, and thank you for being there. Thank you for listening. Our coordinates are there on your screen. You can get in touch with us, social media, email, call, WhatsApp, whatever works for you. Appointment, you can book an appointment with us on our Calendly. You can jump to our website, Infinity Financials, profitwealth.com and .ku, and you can be there and just book in something with us or call us up. We are happy to share no obligation advice or happy to share our minds with you. Thank you so much for coming.
Thank you.
Thank you, guys.
Thank you, guys.